There's a huge disconnect between mega-cap stocks like Amazon or Apple and those trading on the Russell. Right now, the Russell 2000 is still far below its all-time high experienced back in August 2018. Some worry that this is an underlying sign of trouble in the economy, or is it simply overblown hype and a great opportunity to purchase? Well, you came here for the truth, so let me unveil that for you. Today we are looking at small companies' big warning sign. This is an issue that is being underreported in the media today because we are always focused on the Amazon and Apples of this world. I'm going to talk about some details today, some economic indicators, some statistics that you need to know. So let's begin by taking a look at this. Here we can see the Russell 2000, and it is very clear to me what has happened over the last little while. As we have seen the S&P 500 and the Nasdaq achieving new highs, we have not had the same for the Russell. So you could see that it peaked out here, which is approximately August of 2018. And if you look where we are today, it's at 1544 versus what we had back then, approximately 1750. So it is quite a bit below its all-time high, and here we are a year and a half later still encountering this serious issue. Now this is what some would refer to as an underlying sign of weakness in the economy, but they could be lagging behind and certainly could pick up in the near future. Only time will tell. Let's take a look at this. Out of the Wall Street Journal, small company shares fall behind in sign of economic worry. The lagging performance of small cap stocks versus big company stocks reflect jitters that the underlying economy is weak, but some investors see bargains. So this is really the fight that's always going on. Is this an opportunity to buy, or is this simply a time to sell? This is what's happening today. I want to show you more details about that in this article. While the most closely watched US stock market gauges have hit new records this year, shares in smaller US companies have taken a beating. Investors are beginning to wonder if this is a taste of what's to come with the wider market. The trouble that we have here is that there's always this narrowing band that we see. Many stocks find themselves below their 52-week high, and then you have a few select stocks, a handful, a small grouping that will achieve new highs, and more people will pile into those, creating a bigger problem in the future. As it says in the next paragraph, the Russell is actually down 9% over the past year. The S&P 500 is up 6%. Now, of course, this is all on the hopes that the Federal Reserve will reduce interest rates and they will stop their quantitative tightening policy. Further down, we see that small cap stocks, which generate more of their revenues from domestic operations, typically rise ahead of a wider market rally and fall behind of a broader capitulation. This is simply about fears of an economic slowdown. You don't really want to own them if you suspect it's late cycle. And of course, this is what the majority of investors are now looking at. They don't think it's going to end necessarily anytime soon, but they know they are near the end of the cycle because now we have the Federal Reserve and all central banks around the world that have understood that they need to go into a new monetary easing cycle because of the weakness that is clearly apparent. And just a couple more points from this article before I move on. The Russell 2000 fell almost 20% in the final quarter of last year. That was significant. We were covering it here on the channel. You still have this overall flight to stability in the markets. If you're on the fence that things might become better with the Fed becoming more accommodative, why not push more into large caps so you have more stability? And that has been the overall sentiment right now going on with investors. With second quarter earnings season underway, analysts are nervously awaiting to see if the final results will deliver a second straight quarterly drop in corporate profits. You can see in the bottom paragraph, 2 consecutive quarterly decreases would represent an earnings recession, which typically but not always foreshadows an economic recession within a year or two. Companies whose profits are squeezed tend to pull back hiring and investment. We'll see if this is the case, but of course we have seen all of these ominous signs like the yield curve inversion and others that have started to add up at this point, And that's why we have seen the Federal Reserve starting to talk about how a new easing cycle is most likely going to occur. This is the Chicago Fed National Activity Index, and this has been the longest streak in the negative, in this contraction that we have seen since the financial crisis. It has a long way to go to match up with that, of course. However, this just shows you one more indicator coming out of the Fed that is really displaying weakness. There is no doubt. So we saw the budget deal going through. I just wanted to make a couple points here, more specifically about the fact that we always see them talking about cutting, but there is never any cuts at the bottom. In practical terms, the budget agreement would increase spending by tens of billions of dollars in the next 2 years, a stark reversal from the budget request several months ago that sought to slash spending at many agencies starting in October. That's the information they put out there initially. They say they're going to do it. That's what the public reads, and then when they make the deal, they don't need to do this. This happens time and time again. It's a joke. Elizabeth Warren says the warning lights are flashing for the next economic crash. So I saw this article here, and that brought me to her actual post on medium.com. The coming economic crash and how to stop it is actually interesting because she makes some good points, believe it or not. So if you want to read through it, I'm not going to go through it all, but I think it's interesting to see somebody actually pointing to this crisis that we are encountering. It's good just to see that happening on any level. It is very important to understand on all levels here, whether that is because of some sort of earnings recession, whether it's because some sort of indicator like the yield curve, whether we are looking at any of the data that's coming out of housing. It doesn't necessarily matter because all of this will end up showing itself eventually. I think it's important to watch it all happen. Last but not least, 300 cleaning robots that can rap and joke to appear on Singapore streets by March 2020. I think it's important to see what's happening with robotics and automation. Many people believe that this is not a concern. Well, of course, you can look at different technologies that have come out. Maybe it's the dishwasher, maybe it's the washing machine, and these things have largely created jobs in many ways. However, look at this on a different level. If we get to a point where the robotics and automation becomes so good that we don't necessarily need another person working, that's when we have an issue. Think about this. Next recession comes, you lay off a whole bunch of people, just like they did in 2008. Then you have this resurgence in the economy that will come back afterwards. Throughout this period of time, maybe if that company can afford to hire a robot instead of a human, what are they going to do? Are they really going to take that human, or are they going to try to use their robotics and automation technology that may have increased throughout this period of time, that may become cheaper throughout this period? I think that's where we're headed. That's all for this video. If you found it informative, please hit that thumbs up. When you hit that like button, you're supporting me. I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. You can get all the details at the link in the description. If you want the audiobook, that's available at themoneygps.com. So you stayed this far into the video, and I wanted to get into the rent GPS. When you look at websites, whether it's CNBC, whether it's Bloomberg, or any others, you just have to look at it and take it and observe what you are seeing here. Whether we look at this, perhaps on the side, stocks rise after strong earnings from Coca-Cola and United Technologies. On the right-hand side, Beyond Meat's stock surges to an all-time high. You have to look around and see what exactly are they trying to do? Are they trying to inform me, or are they trying to sell me on something? CNBC operates simply because they have advertisers that are paying the way. This is important. They have a business to run, and I do not have any problems with that. I am simply looking at this as a viewer, as a spectator, and trying to make sense of all the information. If you personally are investing and you go to CNBC, Seeking Alpha, Bloomberg, and all of this to look at these analysts and these particular individuals to then get advice on what you should buy, well, then you are getting data that has been manipulated. It was not that long ago. It was Forbes and others that knowingly accepted money to create articles that were promoting companies. This was an absolute fact. It came out. Now that story is buried. And I see it all the time. People do not understand this level of truth. And so they look at this information and they say, look, 99% of the information out there is so fantastic. Nothing could be wrong. You know, if you just bury the information, then no one will ever know about it. And that is truly unfortunate. The bigger the bubble gets, the bigger and the louder the pop is going to be. That's all for the Rant GPS. Did you know that Deutsche Bank was given $354 billion in a bailout from the Federal Reserve back in the financial crisis? If you haven't, you got to watch this video. Click on it and I will see you there.